Hello and welcome back to the Financial Illumination podcast. My name is Alan Pereira and I'm joined again by my colleague Harvey Armstrong.
Hello Alan, I'm buzzing to be back. Didn't know if we get the next call up. Continue our pursuit to the number one podcast in the UK.
I think we need to start with the number one financial planning podcast first.
We'll get there.
Yeah, one step at a time. But of course, if you haven't listened to mine and Harvey's previous podcast, it was discussing the dangers of holding too much cash, which is a relatively simple financial planning topic. And today we'll be talking about something a bit more detailed, a bit more technical, should we say, but keeping things understandable and at a high level. So today we'll be talking about one potential solution for inheritance tax, which I think is being ever more present spoken about. And there's a lot of reasons for that. One of them, firstly, is that more and more families are starting to pay inheritance tax. There are two driving forces behind that. So one is the bans being frozen, and they've been frozen since 2009 and will continue to be frozen until 2030. So for those who don't know, everyone has a nil rate band, which is the tax-free sum they can pass on to their nominated beneficiaries. It's currently $325,000 and has been since 2009. So when I say more people are paying it, it's because of that freeze. If you were to inflation link that, it would be currently worth about $533,000.
That's a crazy stat. It just goes to show that I think in 2009, when they last had those figures of 325,000, that was very much. I think inheritance tax was more of a tax for the affluent, and now much more normal families been caught into that net, aren't they?
Yeah, definitely.
When you add up all those nil rate bans, if you're a married couple with children, you've got a house that you're leaving to those children, the married couple get $1 million, and back then that would have been much more significant amount of money than as of today. And to add to that, if you're single, you only get half of those bans. So just by owning a property in an affluent area in London, you're basically caught in that inheritance tax band straight from the off before you even look at your liquid assets. So it's becoming much more of a tax for normal people.
No, definitely. And I think to go one step further, from April 2027, pensions will also be included in your estate for inheritance tax. And that's not all pensions. So that's not the state pension that dies with you. You can get spousal benefits if you're over a certain age. And then that's also not final salary schemes to an extent. But the pensions that are now being dragged in are the pensions where on death there is a sum of money left behind, an invested pot of money, which was previously outside of your estate.
Yeah.
So that means, say, if you die with a £500,000 pension that's been left, that is an immediate additional £200,000 of inheritance tax just from April 2027. Is an overnight change.
Yeah, that's right. If it's over those nil rate bands you get the pension, if that's sat all in the inheritance tax territory, that's up to 200,000 of inheritance tax. And I think for a lot of people, when they come to retirement, their biggest asset aside from their property is likely to be their pension. So just that one change that the government's made, starting from next April, is significant for the amount of inheritance tax that a lot of families are going to be paying. And if you are above those nil rate bands, if you do have a pending inheritance tax problem, it's definitely not worth sitting on it, and it's worthwhile trying to come up with a plan for mitigating some or all of that tax.
I think there's a few things it's done. Obviously, it's brought the conversation to light more, but it's also, I guess, flipped financial planning on its head, because a lot of people would have put money into their pensions with the purpose that they might not need that much in their pension to live on in retirement. It was purely for the inheritance tax benefit. It's now flipped it on its head, and now it's spend your pension first, which was previously leave it behind. Of course, there's a few other ways to deal with inheritance tax. There's gifting into trust, and business relief, which are all great solutions, and they have their place. But today we'll be discussing in a bit more detail whole of life insurance.
Yeah, and I think all those other solutions, I do think we have some podcasts on, or we certainly have content on in our Lumin news. So if you want to explore gifting into trust, business relief, please do have a look at some of our other publications, and it does visit those. A very important point before I get on to life insurance and inheritance tax is all inheritance tax planning is a complex area of financial advice. This is intended purely for educational purposes. So if any of it does resonate with you, if you do have a pending inheritance tax liability that you want to mitigate, please do seek financial advice before embarking on any of these solutions. And obviously we're happy to have that conversation. So in terms of life insurance, it's often overlooked. I think most people associate life insurance as paying out a lump sum on your death, and it's normally to provide a useful lump sum for financial dependence. That could be a non-earning spouse, it could be children that are still financially dependent on you. Somewhere that it can be used though, and it is overlooked, is to actually cover an inheritance tax liability. So it doesn't immediately reduce the amount of inheritance tax you pay, but what it does is it actually provides a very useful tax-free lump sum on death for the beneficiaries, for your executor, to have quick access to money, so they're not scrambling around looking for it to pay the inheritance tax
Yeah,
bill.
because it bypasses probate, so you get it within much quicker.
Well, it's a very important point. So the way you do that is we put the life insurance policy into trust, and by putting it into trust, if you just have it in your name, it will just add to your estate, and that will be liable to inheritance tax itself. If you place it in trust, it's outside of your estate, and it's therefore not doesn't incur any inheritance tax. And similarly as well, you don't have to go through probate to get access to the money. So from my experience, life insurance policies that are written in trust, they lead to very quick payout for the beneficiaries and the executor. There's a few key details that it's important to get right when setting up these policies. You want to get fixed premiums generally from the outset. So what that is whole of life policies, they're fully underwritten. From that underwriting, it's based on your health, your lifestyle, age, smoker status. What happens is the insurer, they provide a premium that you're going to have to pay to insure that lump sum. So it might be $2,000 a month to cover a set amount of sum that we set up to be broadly in line with what we think your inheritance tax liability will be in the future, or part of the inheritance tax liability. We don't have to cover the whole thing, but in many cases we do try and cover the full liability. The second thing is that we set it up on a whole of life basis. So the majority of life insurance is written for a term, so say 10 years. Why we don't do that for inheritance tax planning generally is that if you then pay those premiums for 10 years and live one day past that 10 years, you've essentially paid all the premiums and received no benefit. So what we do is we write it on a whole of life benefit where there's no term, and basically as long as you keep paying those premiums, it's a guaranteed payout on death. And as I said, we try and set it up so that the payout is broadly in line with your inheritance tax liability. So for the right person, it can be a really useful financial planning tool to, as I said, cover your inheritance tax liability, not necessarily reduce it.
And I think with a whole of life plan,
Yeah.
that it has always been there as a solution for inheritance tax, and I think it's becoming more popular now as a result of that change with the pensions coming back inside the estate.
Yeah.
So how would you, for a client who's got a large pension, what would you look at doing where they've got kind of a surplus of pensions?
Yeah, so with the pensions coming into the state next year, as we said at the start, a lot of people had actually been using that pension, not necessarily for their own retirement income, or not all of it for their own retirement income, but actually as a useful way of having money outside of their estate. So if they're not going to draw down from the full value, it was previously outside their estate. Now it's going to be subject to inheritance tax. But what you could do is use some or all of that pension to actually cover the premiums for the whole of life insurance policy that covers the bill. So it's a neat way of using essentially money that's coming into your estate as of next year, using that as a tool to fund a new inheritance tax planning strategy.
So how would you go about setting that up?
So generally what we'd do is we'd use the part of the pension, and I keep saying part or all, what you need is financial planning to actually know how much of the pension you'll need for yourself first, and then potentially where you've got, as you said, a surplus of wealth. But you use it to buy what's called an annuity. Now, an annuity, you essentially pay a lump sum to buy an income. So you give up a certain amount of your pension to receive back a guaranteed income for the rest of your life, and maybe also your spouse's life, of say again, $2,000 a month. And what you can then do is use that $2,000 a month income to fund the premiums of the life insurance policy.
I think that's a really powerful tool because one, the annuity is for life. So it's going to finish when you pass away, which is obviously
Exactly.
when your inheritance tax liability arises.
Yeah.
That's when the inheritance tax is due. And say if you went for a flexi drawdown route, where you're just drawing an income to pay the whole of life premiums, there's a chance that it could run out because obviously you don't know how long you'll live.
Exactly.
That's where an annuity works really well alongside this kind of plan.
It's that, and also to add to that, when you buy an annuity, the value of your pension goes down from day one. So the actual value of your estate on day one decreases. And in return, what you get for that amount that you've given up is the inheritance tax protection with the whole of life policy premiums. So it's almost twofold the benefit. You reduce your estate, and then in return for that lump sum, you've covered your remaining liability. So as I said, for the right person, it can be a really useful tool for mitigating your inheritance tax.
Of course, and I think if you're listening to this thinking, how do I know if I'm the right person? So there's a few different times where it might be obvious that your pension is surplus. So whether you've built up large ISAs or maybe your spouse has a final salary scheme that kind of covers your day-to-day expenditure anyway, and you've got a SIP that you don't necessarily potentially need.
Yeah.
You might have properties, other income, or an inheritance coming in that's just giving you a lump sum of cash that you can then live off. Yeah. They're quite obvious ways of knowing, oh, actually, maybe I don't need my pension. It might not be as obvious, but that's where us as financial advisors use something called a cash flow plan. And what a cash flow plan does is it allows us to take people's incomes, assets, their expenditure goals. Then we use some reasonable assumptions for inflation and investment growth, and then it maps out the next 30, 40, 50 years of their life. So we can identify a surplus and then use that to the best of our ability in line with their objectives to essentially lead to the best outcomes for them in their lifetime, but also for their beneficiaries in the future. And we always assess all of the options alongside each other to see what leads to the best outcome. So I think this is a really powerful solution, but only for the right person.
Yeah, you talk about best outcome. Ultimately, what you're trying to do with inheritance tax planning is, firstly, you want to make sure that you've looked after yourself first and you've left yourself enough assets. But then past that, with inheritance tax planning, what you're really trying to do is make sure that ultimately your net distributable estate, so what's left for each of your beneficiaries, whether that be your children, your grandchildren, make sure that what's left for them is more than if you hadn't done the planning. And that's where it's not the right solution for everyone. A really important consideration is that both the annuity and the life insurance are fully underwritten, and they actually pull in different ways. So with the annuity, the healthier you are, the longer you're expected to live, the younger you are, the worse the annuity rate you're going to get is, because they expect to be paying you that income for longer. Life insurance works almost completely in the opposite way when it's underwritten, whereby the older you are, the more unhealthy you are, smoker status, for instance, all of those things, if they expect your life expectancy to put it bluntly, if they expect you to pass away sooner, the higher the premiums are going to be to fund that life insurance lump sum. So they pull in opposite directions. It's important to align those quotes with each other, and that's where I think financial advice is really important. But as I said, looking at previous cases, the rates do work well together in the right place, and the amount of pension that you give up for the amount of insurance that you get, and the how much your inheritance tax liability is covered, and as I said, ultimately what goes to each beneficiary, it works out very attractively in a lot of cases. Another really important consideration of this is when you buy an annuity with your pension, aside from the tax-free cash element, it's taxable, the annuity income. So what we need to do is, there's a certain degree of tax planning there, what the annuitant's tax rates are at the time. We have to make sure that the net amount of the annuity after tax is enough to cover the premium for the life insurance policy. So there's a degree of tax planning in there as well.
Oh, definitely. I think this works really well for basic rate taxpayers.
Yeah.
And then if you're a higher rate taxpayer, it's probably got to be a bit more careful. You
Yeah.
probably need to give up a larger sum of your pension.
Yeah.
But then would you say there are any other kind of considerations or things to be aware of before kind of pursuing this route?
Yeah, so what's important is there is some HMRC anti-avoidance rules that go into this. So generally, they need to be underwritten separately, the annuity and the life insurance policy. So generally, what you do is have two different providers for each solution, because there shouldn't be any commercial ties there. And essentially, it should be that the outcome of the underwriting for both would have been offered individually, irrelevant of the policies being connected. So there should be no commercial ties between the two policies. As I said as well, there's the tax considerations. There's how you want to set it up, because if you're married, there's some considerations there.
Of course.
So you'd be looking at a joint insurance policy and an annuity with spousal benefits. Again, that changes the underwriting somewhat. You've got to do underwriting for two people, and that can affect the quotes. So there are quite a lot of considerations here. And as I said, it's not the right tool for everyone, but for some people, it can be a really good bit of inheritance tax planning that leaves the beneficiaries with more distributive estate at the end of it.
I think with the pensions coming inside the estate, it's not necessarily, it's giving people a shorter window to kind of start planning, and people's inheritance tax liability will go up overnight quite significantly. So I think it's almost a call to action. If your financial plan or your retirement plan was set at the outset before that change, it's worth having it reviewed, because now, like I said earlier, financial planning has been flipped on its head, especially for inheritance tax planning has been flipped on its head. But I think that covers everything today on...
Yeah, absolutely. I think, as you said, I think more people are getting caught in the net. If you've got a problem, if you've got an inheritance tax problem that you've identified, reach out and seek financial advice, and we can explore any of those solutions we spoke about, and most notably that life insurance one today. It's a great way of turning the thing that's coming into your estate into a tool to cover your inheritance tax liability in the long term. So I think it's, if you do have a growing problem, reach out, get advice, and hopefully we can do something to mitigate that.
Absolutely. Well, thank you for listening to today's episode of the Financial Illumination podcast. Like Harvey said, this is all for educational purposes and not to be constituted as financial advice. Thanks for listening.
Thank you all.